Hey, welcome everyone to another edition of our weekly market chat presented by Huobi Research, where we aim to spark conversations on the latest topics in crypto every week and give our takes on things. So I'm your host, as usual, Jet, with my colleague Hanson. So as mentioned, we're part of the Huobi Research team within Huobi, and we're basically the think tank arm diving into a number of different topics and discussions every week and trying to give you the latest insights. So be sure to follow us at OB_research on Twitter, or you can also take a look at a number of the different research reports that we have published at huobiresearch.medium.com. So, as usual, be sure to leave any questions you have in the channel, and we'll get through to them at the very end of the chat. And just to note that everything here said is not investment advice and does not represent the opinion of Huobi or Huobi Research, and is our own personal opinion. So with that said, let's dive right into it, right? So for this week, I guess everyone's well aware of the last few days and what's transpired with a significant number of events that have happened. So we will be diving through them. Mainly to start off and kick us off is talk about STE and the Depeg and the issues surrounding Celsius, and then we'll have a conversation about the latest market volatility that's where everyone's experiencing right now. And then followed by that, we'll have a quick NFT market update as kind of an extension of the market situation. And then we'll be diving into some recent crypto project exploits, mainly on Osmosis and Optimism. And then we'll also be talking about, I guess, another NFT trend that's also come up recently with the free Meta. So with that said, let's move in, okay? So for this week, to kick us off, we actually are going to be doing a little bit something different. So for the STE Depeg and the latest situation around the fact that so just to give a quick background on what STE is. STE is a staked ETH token. Given the upcoming merge with ETH 2.0, basically it's a liquid staking solution for anyone that wanted to stake ETH. So, given the latest crisis surrounding the Depeg, we've actually invited one of our colleagues, Andy, who will be diving in deeper to give you guys a update and a situational analysis on what's going on right now. So, Andy, how about you kick us off and give your take on what's going on right
Okay, thank you. Okay, so good evening, guys. I'm Andy from Huobi Research. Just now, Tim mentioned about the STETH, and STETH the price already down a lot during these days. So now I just want to dive into some details about the STETH and uh, the market concern about STETH. So as you can see from my screen, this is the STETH report we will publish later. And from my opinion, actually, there are mainly 5 reasons for why STETH has been trading below ETH. From this report, we can see we know that Terra and Luna collapsed last a few weeks ago, and the collapse of Luna and UST already make a lot of connection, make a lot of concern in the market. This is the trigger of the STETH, but when we look at the other reasons, actually there are a lot of there are a lot of there are a lot of incidents about the STETH. The most important one, I think, is the Celsius. As we know, Celsius took a huge loss from staking STETH on Stakeout. Stakeout actually is a platform. It's very like Lido, And Celsius wallet have at least 42,000 stakeholder ST Ethereum on this platform, but on this platform they lost the private key about 38,000 Ethereum. So this one is this one is also a trigger about the price drop down of STETH. And when we look at the pool, when we look at the wallet of the Celsius, we know that as you can see from this picture, the balance of STETH in Celsius wallet is about it's about 400,000, and in just 2 days ago, and right now this afternoon I just checked the balance of this wallet, and it's just dropped down. So so Celsius is also another reason for the STETH price down. So let's look at the third one. A report showed that Admata Research is one of the biggest crypto investment firm, and on July 8, just sold about 40,000 STETH. The following, when you look at this screenshot, this is the screenshot from the Etherscan recording the selling activities. So we know that the biggest outflow of SETH is in RV lending protocol. We can see from this chart below, the staking pool of RV got the largest STETH percentage with a total of 1.4 million Ethereum, worth about US dollar 1.7 billion. So we know that there is a revolving loan in the RV. When users get back STETH by staking Ethereum at little, and then they just supply STETH in RV and then borrow ETH again. So users can just repeat the steps below, and get a lot of STETH from this pool. So as we can see, this is also very a high risk activity. So from this report, we can see this picture. We know the liquidity price of STETH. When the STETH/ETH equals to 0.86 and 41 million US dollars will be liquidated. And we also know that the Ethereum 2.0, the merge of Ethereum 2.0 will come in the few months, but actually there are a lot of concern in the market. As we know, 1 day ago, the Ethereum has just delayed what's called the difficulty bomb. Although the development team said it does not affect the merge at all, but some have been a bit skeptical on the merge of Ethereum 2.0. So a delay would certainly lead to a effect on investor confidence. So from all this reason above, we get some conclusion for the STETH. The first reason is, in the short term, STETH will face a big selling pressure, and in the following weeks, the space will still continue. And second, we know that STETH is pegged to Ethereum with 1.1 reason, so new demand will step into STETH in the second-hand market. So don't worry. From my perspective, the price will goes up compared to ETH. The last point we want to show to users is that in the long term, before the merger of 2.0, there are some opportunities for STETH and ETH. If you are an Ethereum holder and you can buy STETH you can buy STETH in the market, and because SETH is backed by Ethereum, and you can also get a 4% of 4% return from Lido. So so in the long term, I think SET's price will go up, but in the following in the following maybe 6 to 8 weeks before the merge 2.0, your balance will under some pressure. I mean, because the SET's price is below 0.95 or 0.96 compared to Ethereum. So that's all the insights I want to share in this conversation, and this report will be this report will publish on our platform. Also, you can just follow our Twitter and stay tuned. Thank you.
Thanks, Andy. Yeah, really appreciate you taking the time today just to go through your report. Yeah, so I guess, yeah, I just have some quick thoughts personally, I guess, and yeah, maybe we can have a quick discussion about the points raised by, I think, Andy. Yeah, so I guess it's also good to just give a quick, I would say, background on STETH and what it kind of represents, right? As Andy did mention, right? So Ethereum, as a lot of people know, is migrating from a proof of work to a proof of stake network, right? So what that means is in a proof of stake network, people have to stake Ethereum to validators to basically validate transactions. And based on the stake, if you are acting honestly and and the validator that you've staked with acts honestly, you will get a reward. And in a sense where for each block being kind of mined, so not mined, but each block that is being produced on the blockchain, you'll get a reward. And basically that is what STETH does, right? So by staking your ETH, you are going to get a percentage of rewards based on every block that's being produced, as long as everyone's acting honestly. And for STETH right now, I think, as Andy mentioned, the annual rate that you earn from this is around 4%. So the main issue right now is, as Andy mentioned, right? STETH is facing some pressure on a relative basis compared to ETH, because on a normal, I would say, market basis, right? STETH should technically be 1-to-1, if not slightly higher than ETH, because of the fact that you're accruing rewards, right? As I mentioned, from the staking. But in this case, right now, because of the fact that right now ETH has not transitioned fully to the ETH 2.0 model, all the ETH that was previously staked from the Beacon chain back in late 2020 is still locked up, right? So that's the main issue, right? If you think about it, it's kind of like in a market, I would say, product standpoint, it's probably similar to GBTC, where in a trust scenario where things the BTC is locked up and it cannot be unlocked, and then right now it's trading at a discount because of the fact that it's locked up. And as we're aware right now, because of the market situation, people value liquidity, right? They prefer to have their ETH able to transact and do whatever. So I think right now that's mainly the main reason as to why STETH is not trading on a relatively 1-to-1 ratio. And the second point is, as Andy also mentioned, right? So what you can do with STETH is you can actually pledge it as collateral, like he mentioned, on Aave, right? So Aave is a lending, decentralized lending protocol that is very well known in the DeFi space. And what I would say a lot of degens have done, or not degens, but speculators have done, is they've kind of levered up on chain by, like Andy mentioned, where you have ETH, you deposit it, your stake ETH, and then you borrow up based on the collateral ratio that you can borrow, and then you buy more ETH, and then you deposit it, and then based on the collateral ratio, again, you keep borrowing and doing that, repeating it multiple times to get the leverage effect of basically borrowing and depositing the ETH to build up a leverage position on basically FTETH. And that's the main issue, right? Because of the fact that right now we're facing a market crunch, illiquidity scenario. A lot of people, that built up these lever positions, especially on chain, is facing potential liquidation. As you can see in the chart that is in the slide, where after a certain price of STETH depegs from ETH. I mean, I wouldn't use the word depeg because technically STETH is a separate asset compared to ETH, compared to the Luna situation where the UST is actually supposed to be equal to $1, right? So because of this fact that there's a certain liquidation ratio for anyone that's kind of levered up a bet on ETH or STETH in this matter, when the ratio of these two widen, they basically face a margin call, right? And if you get a margin call, basically you're forced to unwind the trade and sell, and that's kind of causing a feedback loop, and it also as part of a market driver as to why ETH, which contributed to ETH's decline so far, right? So that's the main issue. And on the Celsius side, so as Andy mentioned, right? So Celsius is a centralized, I would say, provider of crypto services, right? So the main issue with Celsius is right now on their platform, if you stake ETH, you can withdraw. But the problem is, in the actual sense, right, the ETH that they've been taking from the customers, they've actually been staking it into STE, right? But as we mentioned, STE is locked up. So because of the fact that it's locked up, and it's now trading at a below par compared to ETH, they're facing a crunch too because of the fact that as everyone's aware, in a market crunch liquidity scenario, everyone's running out for the gates, right? And in that scenario, when there's a significant amount of customer withdrawals, and that causes Celsius to have to figure out to pony up the ETH to allow these people to withdraw, right? And that's why I think some of you might have noticed on Twitter that I think over the last day or so, Celsius actually announced that they're going to temporarily ban withdrawals because of the fact that they're trying to work out the situation and kind of figure out the balance sheet in terms of how best to make sure all the assets that all the customers have will be insured, right? So I think that is mainly the main issues surrounding STETH and the Depeg. Again, I wouldn't use the word Depeg, but again, that's mainly the reason why it's kind of traded against or outside of the usual range of STETH or 2ETH. Yeah. So Hansen, do you have any thoughts on this?
Yeah. So I have a question to ask. So if those people who leveraged and stake ETH gets liquidated, what will happen to the price of Ethereum? So
yeah,
because you're saying that they're two different assets, right? So will the price of Ethereum be affected?
So I mean, you can think about it, right? In a liquidation scenario, the person that basically takes the other side of the trade, probably doesn't want ETH exposure, right? I would imagine, right? So in that sense, basically because of the fact that they're getting it at a discount, they're going to market sell and lock in the money that whatever was borrowed, and then basically market sell in the situation, which is causing a kind of a feedback loop. I think in crypto it's very normal to see a lot of these feedback loops where one thing leads to another, and then people are forced to unwind certain positions, and this is just another case of that.
So there's a possibility of seeing a sort of like a death spiral situation if people get slipped.
I wouldn't say death spiral because of the fact that again, STETH versus ETH is not a peg scenario where there was always a guarantee that STETH would trade 1-to-1 until ETH 2.0, where once ETH 2.0 launches, then you can burn your STETH for 1 ETH all the time, right? So right now that burning function is not available because ETH has not transitioned over to ETH 2.0. So as a result, it's only a one-sided situation where you can deposit your ETH for STETH, but you cannot, burn the STETH to get back your ETH right now. But when 2.0 comes out, that should be no problem. So that's the main difference compared to the Luna situation. So just wanted to clear that up.
Yeah, so one stake Ethereum will eventually equal to one ETH, but
yes,
like what are the risks involved now for the average investor for buying one stake Ethereum for 0.95 ETH at the moment?
Yeah, I mean, again, I think it's always the risk associated with STETH is, first of all, as Andy mentioned, as a timing, right? We don't know when ETH 2.0 is actually going to happen, right? A lot of people are speculating to be Q3, but usually what happens with these big announcements and big updates and launches is they usually face some delays, right? So because of that, you're getting a discount to STETH versus ETH because of the fact that you're facing that timing risk, and you're getting compensated, so to speak, for that right now. But I would say other than that, unless it's a smart contract risk that someone finds and exploits, which at this moment there's not. I would say the risk of if you're long-term bullish ETH, right, the risk of holding STETH and waiting for the migration to ETH 2.0, and then burning the STETH for and getting back your ETH. I think it's pretty safe to say that that's going to happen. So.
Okay.
Okay, so yeah, let's move on to, I guess, what's probably on everyone's mind right now. With the latest market drop, right? So as everyone's aware, BTC was trading around 29-30K last 2 weeks. With the last few days, we've seen a complete collapse to where now BTC is trading around 22.5K. ETH is at 1.2K, and there's I would say there are a number of things that really contributed to this latest crash, right? So first of all, it really kickstarted off on Friday because of the fact that in the US there was a CPI print, right? So CPI is a consumer price index, basically tracking the inflation of the economy, right? So based on market expectations going into the event was they were expecting the inflation print to be at least within expectations, or potentially being a positive surprise, right? And I think BTC and crypto as a whole also has that similar priced in expectation. But what had happened was on the day on Friday, the print was actually above expectations, meaning inflation was still higher than expected, right? And taking a step back, right? Why is inflation important, right? So right now, inflation is important because of the fact that the Federal Reserve in the U.S. has kind of made it the mandate to kind of stomp it out, right? So because of the fact that inflation remains high, they can't turn back on the stance of, first of all, raising interest rates, right? So raising interest rates causes a number of different things in the economy to be more expensive, mainly with credit costs and refinancing of your mortgage, et cetera, et cetera. In addition to that, they're also going to be implementing quantitative tightening, starting from July. And what quantitative tightening is basically, previously the Federal Reserve has been conducting a asset purchase program, buying bonds, and U.S. Treasuries, et cetera, to provide liquidity into the global market, right? And now they're withdrawing that liquidity, and I would probably say this is one of the main effects of why I think the market has not done well this whole year, because of the fact that with the market liquidity situation expecting to be tightening, everyone's kind of trying to take profits, right? And as a result, the whole market has been on a downtrend ongoingly. And a lot of people were hoping that potentially, if the inflation print was going to print lower than expected, that the Fed might ease off the gas, right? In terms of not being as aggressive with potentially the tightening program, or increasing interest rates as quick of a rate as currently, or as high as expected. So a lot of these things were kind of expected going into this print. and of course did not manifest. And basically because of that, you saw a complete carnage, not just on the crypto side, but also in traditional markets as well, where I think the S&P and Nasdaq both fell around 3 to 4%. Over the last few days, over the last day, right? So mainly that's just unavoidable, right? And in this week, the main headline is the FOMC meeting for Tuesday and Wednesday. So everyone's kind of waiting and seeing whether or not the Fed, after this latest CPI print, would potentially further increase its hawkishness of its stance. So right now, everyone's waiting for that. Remains to be seen. So to be honest, in terms of risk taking right now, I think everyone should probably pare back the risk a little bit and kind of adopt a wait and see mode, because like there's no rush, right? I mean, if crypto is following traditional markets and traditional markets are reacting badly to whatever the Fed is doing, like you aping into any token right now, I think is pretty risky. So again, of course, not investment advice, but that's just my take. Hezan, you have any opinion on this?
Yeah, so cryptos are generally considered as a more speculative and more volatile asset. So when there's a lot of uncertainty and fear in the market, people's first reaction would usually to shift their investments in this kind of risky assets into more stable assets like government bonds or banking or stocks in the banking industry. So
yeah, no, I mean, just to add on that, I mean, as much as I think a lot of people would hope that crypto trades uncorrelated to traditional markets, I think what we've seen this cycle for the last year or so is that at times of market stress, it correlates significantly with traditional markets, especially the Nasdaq, because crypto is kind of seen as like a riskier bet play than tech stocks. It's still kind of tech, right? If you think about it, it's technology on the financial side, right? So because of that bucket that people have kind of pinned crypto in, and seeing it as further out the risk curve compared to the Nasdaq or large cap tech stocks, that's why you're seeing it even more aggressive selling, because the first thing people would dump is probably crypto, and then they'll try to pare back their tech exposure, and then closer to safer side will be like you mentioned, has in like the utility stocks, bank stocks, et cetera, et cetera. So yeah, right now I think in terms of risk appetite, it's pretty much at an all-time low. For anyone looking through the next 18 months, I think if the Fed starts showing signs of potentially pivoting, that's probably a better entry than right now, because of the expectations that no one knows what's going to be happening. So definitely be careful.
So moving on.
Yep.
NFT market side. So the NFT market took a hit as well in this market crash. In the past, there was usually a negative correlation between Ethereum prices and the floor price of NFTs. So meaning that whenever the price of Ethereum drops, the floor price of NFTs usually increase, because people see cheaper Ethereum prices and opportunity to buy NFTs at a discount. But however, in the market condition right now, we are seeing both ETH prices and NFT prices dropping partly. So looking at the Nielsen's 500 NFT 500 index on the left, the year-to-date change of NFTs in USD is at minus 66%, and the year-to-date change in ETH is at minus 11%. And in the last 7 days, popular NFT collections like the Bored Ape Yacht Club have dropped around 14%, and the Mutant Ape Yacht Club dropped 22%, and Clone X has dropped around 32%. And surprisingly, the best performing NFT collection was CryptoPunks, which only dropped 3%, and in the past month only 5%. So it is currently trading around 50 Ethereum. But do keep in mind that we're talking when we talk about floor prices here, we are talking in terms of Ethereum. So if we're talking about their actual USD value, CryptoPunks have actually lost about 50% of its USD value in the past month. And looking at the volume chart on the right, we're also seeing a lowest levels of trading volume in the NFT market. So
yeah. I mean, just to interrupt. Yeah, I think there are a few things I want to point out. I think for NFTs in general, right? So if you think about NFTs, right? NFTs is the most illiquid part of crypto assets right now that's available, because for every unique NFT, you need a unique willing buyer compared to tokens where you can trade it at an AMM on a decentralized exchange or a centralized exchange like Huobi. But for NFTs, you really need a buyer for that specific NFT to have demand and liquidity to sell, right? And in times of market stress, even though the floor price is saying one thing, I would say floor price as a caveat is the lowest price being listed on an NFT marketplace. That does not mean it is the actual clearing price, right? So those are two different things, right? So for anyone that's actually trading NFTs right now, definitely be aware of the fact that what the actual spread is between actual recent activity that's actually cleared in the market and the listed floor price. Because floor prices, just by looking at them, can be very deceiving.
Yeah, if there's no liquidity at all, your floor price doesn't really matter, since no one is willing to buy those NFTs. So so in this market condition, we're seeing some interesting trends. So the chart on the bottom shows the trades in wrapped Ethereum as a percentage of total volume on OpenSea. So for those of you who don't know what wrapped Ethereum does, is that they're used to make bid offers on OpenSea. And most bid offers are usually significantly lower than the price or than the floor price. They target those people who want to sell the NFTs immediately for ETH. So a high percentage of total volume in wrapped ETH means that people are accepting bidding orders that are they are undercutting them, and so it's an indicator that NFT holders are selling below the floor price. They are panic selling and trying to exit the market. And the chart on the top shows that the average price per WETH trade has shot up. This shows that the people who are accepting the bid offers are holding expensive NFTs like Bored Apes or Moonbirds that has a higher Ethereum price. So this is a signal that many whales who hold expensive NFTs are losing confidence in them and trying to leave the market and sell their NFTs at a discount to those lowball bid offers. And for those of you who still believe in the long-term utility or value of NFTs and are looking to buy into the dip, it is a good idea to look at which collections are the most traded, most trending during this kind of market crashes. So I believe that the most liquid and most traded NFTs during a market cool down are often the true blue chips. So it means that despite the uncertainty and fear in the market, some people are still seeing value in this in these NFT collections and are still buying them. And so in the top 10 most traded NFTs, we also continue to see Yoga Labs dominance, and there's four out of 10 top traded collections are owned by Yuga Labs. So looking at the on the graph on the right, the seller vs buyer ratio is at all-time high at the moment. So please do keep in mind that when this happens, it also indicates that there's not a lot of liquidity buying into the market at the moment. So people are trying to leave the space. So you should be more aware of this if you are trying to sell your NFTs, because you might not be able to find a buyer in a short period of time.
Yeah, I just wanted to add, I guess, again, a point that Henshin did touch on was the fact that the price of ETH also has kind of increased. I think that's in addition to what he mentioned. I think another thing is because NFTs historically has been denominated in ETH terms, right? I think a lot of people might potentially be, discounting not just in ETH terms, but also in US dollar terms to get rid of those assets. And it's a compound effect, right? Where if you're lowering just the ETH price, and keeping the amount of ETH that you're selling for fixed, right? You're losing money. But then you're losing money on both ends if you're decreasing the amount of ETH that you're willing to take, plus the price of ETH actually going down, right? So I think maybe for me, my personal take on NFTs is that right now it's probably not the best idea to denominate the NFTs in ETH terms because of the fact that this was mainly a legacy carryover from, I think, probably previous cycle. It's kind of misleading, right, in terms of actual pricing in good times and bad times, because if not the average person denominates themselves in ETH. Right, so I think most likely what you're gonna probably start to see emerging next cycle is a lot more things priced in stable coins like USDC, USDT, because of the fact that end of the day for the average consumer like you and me, right? I want to actually know in a stable fixed currency how much I'm actually paying for, right? And able to easily calculate that on the back end, as opposed to denominating myself in ETH, which is a very volatile asset. I think that for the average person, it doesn't make sense, right? And you have to keep running those back, mental calculations just to make sure that you're not losing money, right? So I think next cycle we're most likely going to be seeing a transition to more USD or stablecoin related types of pricing because of the fact that for the average consumer, it's just doesn't make sense to be denominated in ETH. So just a minor note. Yeah. So moving on. So there are a few exploits that we just wanted to mention and talk about. So the first one is Osmosis. So Osmosis is a multi-chain DEX on Cosmos, the Cosmos ecosystem. So what had happened was last week, what was announced was a person on Reddit actually pinged the team and let them know that there was a potential exploit that could be had. So what had happened was, if you deposit into a liquidity pool and you withdraw pretty right away, you would have gotten 50% more of the value that you deposited. So what had happened was this ended up being exploited, of course, after someone probably saw it on Reddit because the guy posted it on Reddit to inform the team. And Osmosis, as a result, had around $5 million being drained from the liquidity pools from this method. And basically what had happened after that was the team worked with the network validators to stop the chain to kind of fix the issue to prevent a further draining of the liquidity pool. And that's kind of the situation. And on another exploit is optimism, right? So you've heard us talk about optimism for the last few weeks. Clearly it's been a very hot and trending topic because of the fact that it's the first layer 2 to launch its token. And what had happened was apparently around the time of launch, Optimism sent 20 million OP tokens to the wrong address. So initially they were aiming to send the tokens to the wallet address of a market maker called Wintermute. But what had happened was Wintermute actually was not the wallet owner on the Optimism Layer 2 that I guess the wallet address that they provided, right? So that the OP team thought they had because of the same address on ETH. So because of that, a exploiter was able to receive 20 million of these tokens and sold around 2 million of them in open market, basically dumping it right away. And eventually, the OP team and this exploiter was basically able to come into the agreement where he basically returned the remaining 18 million back to the OP team, right? So this was kind of dealt with in a kind of a white hat situation. But I mean, I guess right now the main thing I want to bring out from this point is the fact that in times of market stress, a lot more people are going to exploit things that are able to be exploited, right? So, the smart contract risk side of things is definitely heightened because of the fact that as things start, facing illiquid and, rare scenarios, a lot of these, financial products or DeFi projects have not been tested in significant stress, right? So we don't know potentially what kind of risks are associated with that. So definitely be on the lookout of these kind of risks. And definitely have a assessment of whether or not the project that you've kind of put your tokens in or staked, have kind of being kind of vetted and also not not that easily exploitable. So
we know that the hacker of the OP tokens eventually returned 18 million tokens back to OP and sold the other 2 million tokens. But I've been wondering, so what if the hacker instead keeps the OP token and use them to vote in the DAO decisions in the future? Like, will the stolen tokens be counted and still be regarded as valid votes?
Yeah, I mean, I would take a step back first, right? So usually, if you're facing an exploit scenario where someone was able to take a significant number of tokens from a crypto project, they go into kind of a negotiation mode where the hacker or the exploiter would be in communication with the team, and they'll kind of negotiate back and forth on kind of a white hat hacker agreement where they are able to keep a certain portion of the funds and then return the remaining a significant amount. And this is mainly to kind of incentivize the hacker to basically give back the tokens, because in a crypto scenario, there's no recourse, right? If things moved on chain, they are gone, right? They're gone from your wallet. They're gone. So because of that, unless the hacker sends it back, OP technically cannot do anything technically to retrieve those tokens, right? And because of that, they came to the agreement where basically, they returned that the hacker returned 18 million of the 20. And I think from the hacker standpoint, if you think about it, right, I'm basically able to do, get a 2 million OP token. I think at that point it was trading over $1. So it was like a $2 million payout without potential legal prosecution. Because basically with all these crypto projects is they probably hire investigators and report and file a criminal report with whatever jurisdiction they're at. And if you so happen to be in the same jurisdiction, they'll probably hunt you down, right? Or even if they're not, I think there are situations where Interpol was involved and people literally hunt you down and try to basically force you to give back the tokens or arrest you, right? So from the hacker standpoint, I mean, if I'm getting a $2 million payout, am I really gonna risk that? It's risk free compared to holding 20 million and potentially getting arrested and jailed. So I think for the hacker, usually they take the route of just returning the significant amount of tokens and just call it a day, right? So, but in the scenario that you mentioned, is it right, where the hacker keeps the tokens and actually votes and uses it? I mean, there are two scenarios, right? So first of all, the first scenario is as the team, they'll most likely have a majority of the tokens. So if that is the case, they can always have a quorum where they would be able to vote to carve out or reissue the token if it's a really bad scenario, or basically figure out find a way to kind of carve out that portion. But from an on-chain actual voting governance standpoint, yeah, they can't do anything about it. So the person holding those tokens could definitely be used to vote. But I mean, if you think about it, they can always label the wallet as OP exploiter. So if he votes for anything, then basically they can potentially disregard that wallet's address's vote by voting through governance to basically ignore any voting sent from that address, right? So I mean, there are a number of ways around it, but basically, I don't think the typical way is to hold all the tokens and keep it. So
Okay, I see. So moving back to NFTs, another interesting trend we have spotted before the market crash was the large drop in average Ethereum volume per trade. So average Ethereum per trade has went from 0.7 ETH in May to 0.11 last week. And the reason for this drop was probably because of the new free mint trend popularized by Goblin Town. And Goblin Town has inspired many collections to launch with no minting cost, and as well as no Discord, no utility, and no roadmaps. So one of the more popular projects that came out from the recent free mint meta was Poop NFTs. So at one point last week, there were 4 collections from that project team trending on OpenSea. So the this NFT project got popular for its cultural values and vibes. So instead of saying we all gonna make it and promising ambitious roadmaps and utilities like every other NFT projects, this project clearly say that you're not gonna make it, and their NFTs are just a piece of poop. So the joke is that they are literally selling poop to you, and people are buying into the joke in this boring and painful bear market. So, but however, although their NFTs looks really like a degen, low quality, low effort mint, their team's execution actually tells you otherwise, because they have already launched 3 NFT collections and a token in a matter of 2 weeks. It took them 2 weeks to accomplish what Bored Apes have done in 1 year. So keep in mind that unlike most other NFT collections, this is a collection with deflationary mechanics. So 6,000 Genesis NFTs have been burned already to create the next Genesis to create the next collection. So right now they might have a high price for, but it's mainly due to their low supply because of deflationary mechanics instead of having actual demands. So they also have launched a token, the shit token, with the ticker symbol literally being SHIT, and they can be used for burning, combining shit beasts and burning to create another new collection in the future. And there are also hints that they are trying to make a metaverse project regarding poop NFTs that will be powered by this coin in the future. So if you're interested in trading this coin, we at Huobi have listed it in our exchange just a few days ago. And
Cool.
so
Yeah. So I guess before we go back into the usual candy drop event, just wanted to again repeat if any of you guys have any questions about the topics or anything in general, again be sure to leave it in the chat, and we'll get through to them after the candy drop.
and so as usual, we'll remind you guys about our candy drop event. So users with an average spot trading volume above 100 USDT of any digital assets for the last 3 days can register and participate in the event. And participants have the chance to win up to 100 USDT per entry and up to 1,500 USDT per week. So the more trading volume you have, the more entries you can register for, and the higher your chances of winning are. We'll also airdrop a candy drop double up coupon to those who didn't win anything. So, and using the coupon will double up your chances to win in the event. You can stack the coupons up to a winning chance of 100%. Moreover, for each candy drop event, one lucky star winner will be selected to win a grand prize of 1,000 USDT. So for more information, you can go onto the Huobi app and click on the new listing event page for information about this candy drop event.
Okay. Yes. So let's just dive into the questions that we have. I see we have 2 questions. So a question to you, Hansen. So what does the shitcoin do?
Right now they are mainly used for maintaining the next collection of this proof NFT project. And I think they also have plans regarding staking, but details are not yet released. So there's staking utility and there's purchasing utility.
Okay, and then the second one is, what is the total supply of it?
I think it's around 1 trillion, or it's around 1 trillion. Yeah, there's a lot of zeros, and I did not count all those zeros. It's absurd number of zeros. I think you can check that in CoinMarketCap.
Okay. Well, I guess this wraps it up for this latest segment of the weekly market chat. Again, be sure to follow us at Huobi_research on Twitter, or you can also take a look at the research reports that we just talked about. Similar to the one that Andy has kind of walked through today for us on huobiresearch.medium.com, where that is the place to be to look at all the research that we have published. So thank you everyone for taking time again today to listen to our conversation. We'll be back here next week at the same time, and look forward to seeing you guys again. Thanks.